we are watching, in my opinion, the next stage of gambling the entire system, the eventual, for maintaining the existing Ponzi, basically, which is treasury purchases. There is no one with $1 trillion every 2 months. Nobody has that kind of income. Even China, with all its trade, doesn't have the means. I think they topped out in total around $1 trillion, and they sub $1 trillion today on all-time accumulation of treasuries. And there's a new trillion every 2 months. So who's been the buyer? Well, we also had the French and the UK. I call them the slave nations that are tied to the post of the Western hegemony. The only thing that's good for the collapse for America is that they won't be alone, because they're going to drag down the entire Western world. Much as I don't wish any ill on America, I have my suspicions surrounding people that comment about a great auction for treasuries again today. You get a lot of this, all these people talking about, the dollar's under threat. Look how well demanded the treasuries have been, et cetera, et cetera. And there's been recent revelations, but it's worth also putting why these recent revelations have come out. There was an event in April that was very specific to the gold market, and I'll tie all this back to gold, because I don't want people to think that we're just going on a journey in the wilderness here. This is a gold story in the end, and a silver story, very, very strongly so. In April, at what we called and named peak Trump tariff tantrum, which was when the very first time he was getting super aggressive and levied triple-digit type tariffs across the broad spectrum of nations, but the ones on China being probably the most significant due to the trade relationship that is held there. We ended up getting an event that saw treasuries spike down in value, rates spike disproportionately up. And I will show you that event on the charts when we refer to the technical section in the second half of our chat. But I want to put that landmark for everyone to remember. And of course, what also happened, which brings us back to gold, and I will be tying, once I've taken you for a little bit of a walk in the wilderness, I'll be tying this all back. Gold ran, having done our target of 2,900 and 3,000 that we had suggested when we were down at 2,000 on your channel. Gold had a surge from the 2,900, smashed right up to 3,500. And that was its peak. And then we got put into an April till September continuation pattern that recently broke out and led to the 3,350 runs right the way through for another $1,000 to the high end of 4,350s. And since then, we're having our pullback. But going back to that April moment that was super, super violent, what was really behind that? We called it peak Trump tariff tantrum. And the great irony about that is Donald Trump came out and said, without being prompted, I don't know how this came out, but ended up saying, we weren't worried about the bond market. Now, what's happened since then is the Bank of International Settlements, which for those that aren't familiar is a Swiss-based central bank to all central banks, highlighted that there is a crowding out and real systemic risk brought about by a very crowded trade, a very highly leveraged crowded trade. And that trade is what's known as the basis trade. So a top line, everyday man's explanation of the basis trade without losing ourselves too much in fin speak and gobbledygook jargon is basically the following. Leveraged hedge funds buy treasuries. They do so with great leverage. So they're typically putting 1% and 2% maximum down. They are being levered up, essentially 100x, and are holding this. They are then pledging it as collateral, and then they are securing further leverage. They are shorting the futures markets, which typically trade higher than futures are basically, particularly on bonds. It's just fiat, but it's fiat with a delayed delivery. So it's all about fiat. Even debt markets aren't really debt markets, they're fiat markets. We say we merge the two back together. They're Siamese twins, but they're one and the same. But it's just delayed delivery fiat. A bond. That's all it is with a maintenance cost. So in essence, they are shorting futures on the basis by the time the expiry comes, the futures typically come back down and meet spot on delivery day. There's no point in buying a more expensive future for delivery the same day if you can buy a spot cheaper. So invariably they come down. So they're shorting the higher line that comes down and buying the undervalued asset. So Many will say, well, technically they hedged because they're long the same assets that they are short. The problem comes in is most markets have what's called contango. That means the future delivery costs more than the present ownership. There's in things like gold and oil, obviously there's storage costs. When you're talking about paper money that is all digitized, it's more about opportunity cost and also interest rate costs, and maybe a little bit of inflation that creeps in there. As well being priced in. So they are getting a very meager return. It's not a great trade, particularly. It's a very meager return. How do you maximize a meager return? You apply a huge amount of leverage on it. But there's also costs. And in the financial running of this basis trade system, they are pledging the collateral. They're even letting go of ownership for it for a while and financing with the repo markets, which brings in the intricate plumbing. Repo markets are the interbank lending, where excess deposits can be lent to other banks at a low liquidity levels overnight just to shore up a short-term cash need. So you have all of this interbank plumbing that typically doesn't affect you and me in the streets. Of course, it also extends into money markets. Now, just an aside, not specific to the basis trade, Warren Buffett is getting a lot of attention for having one of the biggest holdings in the money markets. I think he has in excess of 300 billion in the money markets, where he's earning around 4, possibly a bit more, percent on that on an ongoing basis because he's unhappy with equity valuations. So he is providing liquidity technically via the money markets for interbank lending. His bank can make up those excess deposits available to other banks that might be short. And all of this is a funding mechanism for aggressively levered through the primary dealers who are facilitating the hedge funds for putting this trade on. And I compare this to subprime. The only differences is subprime, you and I as men in the street got to see. We had a friend at the dinner table who had 10 apartments but didn't have the money for one. He just put a good faith deposit, a very menial one down. Some had even got 100% finance or even beyond 100% finance. We could see there was something odd going on. Is all inside the bowels of institutional banking, primary dealers, repo markets, money markets that most people don't understand. And there is excess leverage building up there that's likely to cause a repo crisis or a money market crisis. And this is so systemic. The point of BIS that brought this out about what's going on in the treasuries are truly held by the Cayman Island, and saw that an already big whale in treasuries was understated by was only 25% of the position they truly had, the true value. Tiny Caribbean island, you're talking about a speck of an island that has 7.1 billion as of 2023 GDP. Now, let's just say 7.1 billion GDP is the equivalent to a man's income for a year. If you were on 250,000 a year, Elijah, you would have, and you were the Cayman Islands, so your 250,000 is equivalent to 7.13 billion. They have 1.8 trillion in US Treasury exposure. That would be the same as you, with your $250,000 annual gross salary, having 68 million bond portfolio. Now, I think you would be thinking that if you were on that income, you might have a bit of gold, you might have a silver. It would be quite unlikely that you'd be deep in the 7 digits on anything on $250,000. You have a bond to pay, you have other expenses, etc., on $250,000. But 68 million bond portfolio is deeply improbable with that level of income. That is the scale to which the Cayman Islands has become this bottomless pit buyer of what I consider to be Ponzi-onomics, which is 1 trillion every 2 months. We've just crossed into 38. It was 2 months ago, we crossed into 37, and it's escalating. We will be 40 trillion before the year end. It starts with a 4. And who are these big buyers? They are being financed by repos, overnight, daily repo funding and the money market system. And it's a crowded trade. And all you need is for futures to go into backwardization instead of contango. They are so leveraged and they consider it such a certainty, and they've all been jumping into the space and getting these returns. You just get the future move away from the cash markets, and they will not have the margin to hold it up. It becomes systemic, too big to fail. Fed has to stand in. It's a long-term capital markets parallel as well, because they put the entire system at risk, and therefore you create the next bailouts for, it's not even for retail. Socialized cost on the rest of us, major profits. The people who will gain out of this folly, though, and how do we ensure ourselves, is gold. The point at which we had this event in April, it's worth showing you what gold did when all of this had its wobble. That has led to all these recent exposures that we are now discussing. It was this period here that saw this huge run up